And good afternoon, and welcome back to another episode of Money Matters. My name is Nev. I am excited to do this. As you know, I don't typically do the afternoon shows. In the afternoons, I end up just working. But I did make a promise to a particular group of individuals on my Facebook group page that I was going to review real estate market and what's going on. And because we had this giant meltdown with the stocks, I figured I need to honor my promise, but I also need to honor the promise of what Money Matters is, to talk about what's going on in the world of economy and money. And the interesting thing is that I just quickly actually jumped on to see what's going on with the Dow Jones. And lo and behold, I was right. We are up just slightly over zero. So we've been flirting between like 1% and 0.5%, potentially down. So who knows? It's going to be a down today, but that's not what we're going to cover over here. So anyways, I think we might be stepping into the second or the third phase of the real estate market, but that's not what we're going to talk about here. Well, no, I said third phase of real estate. No, third phase of the market and economy. And now we are going to go and talk real estate. All right, y'all. So let's get to business. Let's do this. Let's talk about what's going on in the world of real estate. I did make a promise. I want to make sure I honor it. And so first off, I want to start off with what's happening over at the real estate market by basically checking out the Twitter. And I think I told you that I am starting to sort of get back into Twitter. I don't know that I'm back into tweeting quite yet because I am long-winded and this whole number of characters is really bizarro for me, but eventually I will get into it. But I do go in to check it out, and one of the interesting things was that, hey, there's like way less listings this year compared to last year since the pandemic began, and this is what's going on in Sacramento. So this is actually what's happening in Sacramento. It looks like Sacramento County, so that's Northern California, in case you're not from United States or don't know where Sacramento is in United States. And you can clearly see that things have actually dropped. Now, there was an interesting sort of question of like, hey, anything happening with the distressed selling? Because that would be my question that I would have, right? I'm like, hey. But they're saying, hardly a factor. That could change in the future, but they've essentially bottomed out for now. I'll put some fresh stats later on this week, and you can see that right now there's really not much happening. They're like pretty much the same thing. Now, another piece that also happened is what's happening with the mortgage rates. So take a look at the chart. There you go. I use the opportunity for you to look at a chart so that I can hydrate. You got to keep on hydrating, y'all, especially when you talk all day long and you're trying to project, because you can't do this in person. You got to do it on the camera. So anyways, treasury rates dropped about 90 basis points while mortgage rates barely budged, edging down down by roughly 10 basis points. And if we actually click on this stuff, there's an interesting sort of narrative that you can see right down here. That you will see that there is a 10-year treasury yield which is going down, right? That's telling me we are going further into recession, and I've been calling it. It's going to be a depression, y'all. There's no way around it. Again, I could be wrong, but that's the way I see it. I've been calling it since February, March area, and I'm still sticking with my prediction. Current coupon, as you can see, basically not doing much of anything, and 30-year mortgage staying mostly flat. But I do have an update for you later on today, so make sure you check in this particular episode. Now, what they're basically saying is that there's something weird happening that we can't explain. because of the virus and because of everything else, it's not coming in. For me personally, if I really think about it, it comes down to the risk and whether the banks want to take it or not. It really comes back down to whether the bank believes that when they loan you money for your property, say at $100,000, is it going to remain $100,000 in 6 months or 3 years, or is it going to drop down to 80,000 or lower? That's the reason why they're not lowering it, because they don't want to take the risk around it. Now, I do have what's going on with the rates. So let's take a look. So what kind of real estate report would this be if we didn't talk about mortgage rates? So this comes from Bankrate, and they're looking at it and saying like, hey, it's sort of dropping, but not really. You will see that last week it was almost 3.5. Now it's 3.3 for the 30-year fixed. 15 years, like, barely any movement. I wouldn't even brag about it, y'all. Seriously. When you're seeing 30-year jumbo, it's actually going down lower, and then refi is slightly lower, but still higher than purchasing of the new one. Now, this is what's coming out of Bankrate. However, Yahoo Finance reports something very different. So let's take a look at what they're saying. So here's what they have to say. They're saying mortgage rates have dropped to a breathtaking level. Most popular home loan, the 30-year fixed rate mortgage, has fallen below 3% for the first time. I don't know about that. This is as of today, right? So this was written today. This is today's news. Like, talk about fresh off the press. And the reason I'm saying I don't know about that is because I've actually reported that there have been mortgage companies that are offering as low as 2.5% for qualified buyers and refinancers. What, about 2-3 weeks ago? And I've actually had that on my website, on my Facebook page. So that's the reason why I'm saying I don't know about that. I think that that's grossly wrong, and I absolutely disagree with what's happening and what's going on. And I do want to welcome all of the folks that are viewing this live on onedealaway.com. If you want, you can register, absolutely register. It's a free account, so it's not like you have to pay anything or anything like that. And you can actually feel free to ask questions. I'm going to go over some of these things. We're going to talk a little bit more about mortgage and what people are talking about, marketplace, what to expect, where to invest, and that kind of stuff. And then when we're done with it, if you're watching this on YouTube, you've missed the show, because when we get into the Q&A live with the audience on One Deal Away, we're actually going to stop recording, and none of this stuff is going to be visible on Facebook, on YouTube, on Instagram, on Twitter, on whatever else ends up going in. So the only place you can do this, you can watch live, you can interact live, is onedealaway.com live. And if you're missing the show today, you definitely want to come and check it out tomorrow morning at 7 a.m. This is very unusual for me to do it, but I'm doing it because I made a promise. And you know what? In my world, the way I like to run business, your word is everything. So you make a promise, you deliver, even if it means working overtime. So here we go, working overtime. So they're saying that it first dropped down to the breathtaking level. I'm like, not so true. But hey, maybe for Yahoo Finance and people that are not watching Money Matters, it is true. Most popular home loan is the 30-year fixed rate mortgage, and it's fallen below the 3% for the first time. And I do believe that it is the most popular, but I also believe and agree that it's probably the best loan that you can get. If you're going to borrow money, you want to go fixed for the longest period of time possible. The reason for that is that because if something ends up happening, say that I go with a 15-year, of course you can pay it off sooner, but if you get 30-year, nobody's prohibiting you for putting more money in and paying it off sooner, right? But if you go for 15 and something happens and you need to extend it, you can't, because you're locked into the 15. So for me, I'd rather go with the 30 and then potentially pay a bit more if I want to pay it off earlier, or better yet, because I do different things with real estate. I do it predominantly for investing purposes and reasons. And even when I buy a home where I'm going to live in, predominantly it is going to be a multifamily property. So that way I get all of the discounts, all of the taxes, and not only do I get to live for free, I actually get paid to live in a home. And that is beyond exciting to me. But anyways, let's continue on with the news report. The average rate for 30-year fixed mortgage sank to 2.94 from 3.03 on Wednesday. it's interesting they say this, right? And then you go to the bankrate.com and they're reporting much higher rates. So what I recommend for you to do, if you haven't been doing this stuff, is you definitely want to go in and look for your own mortgage rates. This gives you like a rough estimate. If you're serious about buying or refinancing, you definitely want to go in and qualify for yourself. And if you're doing anything from 1 to 4 units, you are going to qualify for a residential mortgage, and that's like buying your primary home. If you do investment, of course, you're going to pay a little bit higher interest rate unless you live in a property, which is what I like. And you might have to put in a bit higher down payment. So they're recommending about 20%, although I would argue you could still probably find slightly lower if you're really, really looking at it. So you got to put a lot of patience and a lot of willingness to basically negotiate and talk to people and shop for rates. So this is kind of what's going on. Now they're saying, how low can it go? Everybody wants to know that, right? So here's what they have to say on Yahoo Finance. They're saying Fed policymakers indicated they're likely to hold rates close to zero for the next 2.5 years. And I think that they're going to do that. I actually personally wouldn't be surprised if it goes negative. But again, they haven't talked about it right now. They're saying that's not even a discussion. But, you know, a lot of things are not a discussion unless they are. And when they are a discussion is when many bad things end up happening. Like, nobody really discussed about sending $1,200 checks to individuals around the country. And yet, we had that. Nobody talked about the second round of that happening, and yet conversations are happening, and the worst, that the economy continues to perform, which I expect for it to do. More of that is going to happen. But let's continue. So they're saying it's likely the mortgage rates are poised to remain low for a while. However, at some point, the lower rates at all times will be behind us for a period of many months or years. And I actually do agree with that statement. And so right now, where we are at one of the lower levels. Could it get lower? Yes, potentially. If you're very serious about wanting to jump in it, maybe right now may not be the worst time to refinance. Because even if it goes down lower, unless Fed drops rates from 0 to 0.25% down to like -1, -2, but there's also no guarantee that the bank is going to actually offer you lower thing for mortgage. Now, we are seeing some of that in Europe, but we are not in Europe quite yet. So if you live in some of the countries in Europe, I want to say Belgium, maybe Netherlands. I know Sweden has been talking about it. Norway is kind of considering it. So we're starting to see the negative mortgage rates coming up. So as crazy as that is, people are like, what does negative mortgage means? It basically means I borrow $100,000, for example, but only have to pay back, I don't know, $95,000 or $99,000. So that's what it means. It is pretty cool, and I will tell you, if that ever happens, Nev is going shopping. But Nev is going shopping regardless, because there are ways where you can go in and buy real estate without going through the traditional marketplace. And if you're interested of doing that stuff, I want to invite you to come check out the Academy, simply onedealaway.com, and just look for Academy. That's what you want. That's what you need if you want to know how to do that. Okay, so now let's really go back to the news. Enough advertising, enough marketing, enough side chatter. You are here to learn. We are all here to learn. That's why you joined here. So here's an interesting article that is saying you can use real estate investment to hedge market volatility. And I will tell you, that's exactly what I did back in 2009, 2010, when after losing everything in a 2008 market crash, stock market crash, I decided this is not for me. This is, my little heart can't handle this stuff. I'm getting out. I don't trust it. I don't believe in it. And I jumped out of that, jumped into real estate, and I've never looked back. Sure, I go back and every so often I play around in the stock markets. I still do it to the date. But predominantly, this is what I like. So here's kind of what they're talking about. And I'm going to give you, of course, my version and my commentary on it. They have their own. I have my own view. To guard against drastic market swings, many investors are diversifying investment portfolios with real estate investments such as single-family homes, condominiums, and apartment buildings. Bouts of market volatility means investors are taking a closer look at alternative investments. 6 in 10 investors are considering investing beyond stock and bonds. That's 60%, y'all, if you think about it, okay? This is pretty awesome. 65% are seeking investment strategies that are less tied to the broad market. Now, what are these, you are saying? What are the alternative investments? Well, a lot of it is going to be gold in physical form, real estate in physical form, not REITs and that kind of stuff, and cryptocurrencies. That is the reason why our Money Matters, we focus on those 3 assets predominantly, even though I overview what's happening in the bonds and stocks, because I, again, know the vast majority of people are in it. Now, what does that mean? Well, average return, annual return in the single-family rental market are comparable to stock market returns and outperform bond returns. But, as the chart below shows, rental home delivered these returns with far less volatility. So you will take a look and see that the blue line kind of going up and down, that's bonds. The red line, you guessed it, that's stocks. And then you have this super boring real estate. My favorite thing. Now, people tend to believe that investing needs to be this very exciting thing, that something has to be happening all the time, that we have to get busy. We always have to be jumping in and out and doing that stuff. And I have news for you. Investing is supposed to be boring. Nothing is supposed to be happening. You know, it's supposed to be day to day. You're living your life, collecting the money, growing your wealth, and occasionally things happen. You go and address them. You know, you review, you reposition, and you go about a way. The way that I see it is, if you want your palpitations, heart palpitation, excitement, visit an entertainment park, go on a roller coaster ride, have at it, have fun, but investing should not be doing that stuff. That's my personal take. Now, I'm going to go back. You can take a look at the chart while I take a sip of water. Okay, so now let's continue. S&P 500 stocks of more than 35% posted 35% in its highest point, and in the span of 25 years that they have looked over here, okay? So they're saying the highest one was 35% return, okay? But it also plummeted equally during the worst year. So what they're saying is you could go up 35%, but you could also drop 35%. Interesting. Now they're saying, well, we take the single-family rental investment, and it's reporting about 7.5% return in the best year, but it's only dipping 2.5% in the worst year. Stock market had a total of 6 years down, while single-family only had 2. Now, when they're talking about this is an interesting piece that I wanted to make sure I point out. So, when they're talking about only 17.5% return, one of the things that they're not talking about at all is the tax benefit that you get with real estate that you don't get in S&P 500, for example. Because when you buy real estate, and again, it differs slightly from country to country, right? But overall, in United States, this is absolutely true, as is for vast majority of the countries. You definitely want to check in with your financial advisors on that. I suggest an accountant, but hey, you can go to anybody you want. There are some serious benefits to owning real estate, where you're able to actually not just lower your tax bracket, but you can actually potentially own all of the real estate, get all of the passive income, and pay 0 tax. Okay? So one true story about me and my personal sort of take, and I praise my accountant all the time, every time. I absolutely adore the man because he's a genius and he's helping me with this stuff. And I will tell you, I personally hug and kiss my real estate every single day because, way back when, I used to have stocks and bonds and ETFs, and I used to have a job, and it wasn't a high-paying job, but my tax bracket was about 45 to 55% per annum. I lived in California, so that might explain why it was so high. Nowadays, my income is about 10x of what it was then. I live not in California. I live in Rhode Island, so not as high as California. But Rhode Island is not a low tax state. I will tell you that much. And my tax bracket has dropped for, let's say, average 50% to an average of about 10 to 12%, maybe 13 on a really bad year. All of that is due to the real estate, okay? And so when you invest in real estate, this 17.5%, that's just the return that you get on your money, on your investment, without the tax benefit. Typically, when you add the tax benefit, real estate investors report anywhere between 25 and 45% return on their investment per year, and that's following a very traditional way to invest, not even the stuff that I teach in the academy, right? So what you get in academy, I mean, you can get in, we're talking 2, 3, 5, 10x before taxes potential return. So anyways, now here is the part that I have sort of mixed feelings about. Let's talk about it over here. Now, they're talking about you have a potential to use retirement funds for real estate investments. And I agree, you do. So, many people believe in your real estate, in your retirement funds, the only thing you can go into is the mutual funds, stocks, bonds, ETFs, that kind of stuff, predominantly mutual funds. But there's a thing called self-directed IRA, and they allow you to invest in a host of different things like precious metals, as well as real estate. I believe that there are some that allow you to invest in cryptocurrencies as well. And we all know that the benefit of investing in things throughout our IRA accounts, throughout retirement accounts, is that it has this deferred tax state. Or if you go with Roth, which is what I personally believe in, you pay the tax today, but all of your proceeds, all of your growth is tax-free. Now, here's kind of what they're talking about here, and then I'll give my commentary, so that way you get two sides of the coin. They're basically saying you get this thing, you go in, you buy the real estate, you collect the money from the rent into it, all of it goes into your IRA, and that's the beauty of it. They're saying real estate involves risk, I agree, and the widespread economic impact of the coronavirus outbreak served to heighten the risk, I agree. Home prices plummeted during the depths of Great Recession. True. The national median single-family rental rate, the midpoint rent the tenant had to pay, never turned negative. Also true. Also something for you to know. While the prices fluctuated, if people were positioned correctly, long-term rentals, typically they didn't care whether the price of that rental went up or down, because they were able to sustain rents and be able to actually make money even during the downturn. That is also true. Diversifying your portfolio with an asset class that does not move in lockstep with the stock and bond market may help you feel more confident weathering market volatility. So I absolutely agree with that scenario. And, even looking at today and looking at March, we saw that when stocks took a dip, so did gold, so did crypto. Now, they behave slightly differently because stocks takes a little bit while to actually go up, while crypto and gold actually switch relatively quickly and go up. And higher the uncertainty, the better the performance with these assets, okay? Especially gold. That has been proven. However, we are facing a deflation, not inflation, so gold might not necessarily work as well. And crypto is pretty new, and while I truly believe in it long term, we don't know what it's going to do in the short term. So things for you to think about and account for that risk when you decide to invest. Now, in this particular article, they were talking about using self-directed IRA to get into real estate. And the reason I'm not such a proponent of that idea per se is because, well, real estate provides the tax benefit. We just talked about it, right? And the IRA provides the tax benefit as well. But when you put something like real estate in the IRA, you actually lose, because you don't get double the protection. You lose some of the tax benefits of the real estate, such as write-offs and those kinds of things. And so while there's some things that you can do with self-directed IRA within the real estate market, like private lending. And by the way, that is going to be a course that I'm going to be putting in and adding into the academy. And it's slowly but surely going to become perfect time to get into this stuff, which is why I haven't created it before. It was bad timing. Now it's going to be good timing, so I'm going to add it in. There is a benefit for private lending within real estate when it comes to self-directed IRA, but I personally would never hold my personal real estate or my investment real estate as part of the self-directed IRA. I would lend on it, but I would not hold it. And the biggest reason is because I lose many, many, many tax benefits when I do that. IRA does its own thing, and I want to protect it from the tax thing, but I don't want to discount some of the other benefits that real estate has. And it's a bit too technical for us to get into it during the show, because I still have a ton of reports to go over before we are done and over with, and I don't want this to be like a 7-hour show, because A, I got things to do, B, you want to go and do something fun on a Friday. All right, so housing apocalypse is coming as coronavirus protection across the country expire. This is a couple days old, but it's still valid. So we know that COVID-19 has sort of taken everything for the loop. It didn't cause many things, it sped up many things. Some things it did cause, many things it only sped up. So they're saying the expert expect the eviction crisis to get far worse in the coming months. Between March 25 and April 10th of this year, nearly half of renters aged 18 to 64 reported that they were having trouble paying their rent or utilities, were food insecure, and couldn't afford needed medical care. To keep people in their homes, the federal government banned evictions and federally assisted properties through July 25th. Some cities and states, including Massachusetts, New York, and Michigan, put their own temporary eviction moratoriums in place. Okay? Many places and many bans are expiring over the course of the next month or so, and some have started to expire in this month. Now, here's an interesting piece that adds to this whole problem. The extra $600 per week in federal unemployment benefits is set to expire at the end of July. The U.S. is likely to experience an uptick in eviction nationwide in the coming weeks. Now, my question to you is, before we continue, what does that mean? I want you to think about it. I don't want to just give you an answer. I want you to actually think about it. If more people are being evicted, what does that mean? And don't tell me more people are going to lose their homes, because that's an easy answer, okay? The answer basically means is that more properties, more landlords will be looking for people to rent to. So what I expect to happen is that the rental prices will have to drop, and we're going to see some rental concessions, meaning sign a 12-month lease, get a month free, right? So that's kind of what we're going to see. We're going to see potentially some lower rents across the markets. We've already done a report, but we've noticed some of that already happening, but I expect that to happen even more. What does that mean to you and I as real estate investors? Think about it. Think about it. We got to be even more diligent when it comes to the price that we're going to pay, okay? So hopefully you have joined me live. I have actually lowered the window so that I can focus on what's happening in the page that I am in, but hopefully you are there. Hopefully you have logged in. I'm going to quickly jump in and take a look. So feel free to put in, questions and comments within the page, and I will definitely jump in, like I said and promised, and we can definitely interact. You can ask any and all questions. So hopefully you're providing some of the answers and stuff. So anyways, let's continue. Eviction has also long-term, in some cases, multi-generational financial consequences for individuals and families. It can ruin tenants' credits for many years. This is very true. So if you are a landlord, okay, I don't know who you are. I don't know who's watching this stuff. So if you're a landlord, what I'm asking of you to do and be is a human being. Work with your tenants, right? I'm not saying let them live there for free for a year, because that's not fair to you, because you got to pay mortgage. You got to feed your family as well. but work with your tenants. I have had an unfortunate experience to have to evict some of the folks. 99% of the cases, I've never had to go to the eviction court. Not because, I've done something miraculous, but because I've worked with folks and sort of explained to say, hey, I understand where you are. I understand you can't pay. Can we work something out, right? And if you can't pay, that's cool. I understand. If we have to go through the court, we have to go through the court. I prefer not to do that. I prefer not to destroy your credit. So I spend time educating my tenants, having a conversation, and basically coming up with a deal where they'll move out without them having to go through foreclosures. 9 times out of 10, that works. They end up moving out. They're grateful that we're not doing this stuff because it doesn't affect their credit. We never report it. They move out. It's faster for me. It's easier for them. And it's cheaper for everybody. So if you're a landlord, that's what I actually suggest you do, is have a conversation, an actual real conversation with your tenant like they're a human being, because they are, okay? They're not being evil. They just can't afford it. So work with them. Be empathetic. Understand, explain your position as well, and then work things out. Now, every so often, you might get a tenant, you can't work things out, they're not willing to move out, you have to go through foreclosure. I get it. You have to do what you have to do in order for you to keep that home and in order to keep paying basically keeping your end of the bargain. So I get it, but do be kind, please. Now, how to stop the incoming crisis? They're saying that the crisis requires a large-scale government response, and I agree. If state and local government doesn't step in to help soon, there will be a tsunami of eviction. I also agree, because if you think about it, and oh, sorry, I forgot to change the screen. My apologies. This is what it said. Here you go. You can take a look. I apologize. I agree with this because, if the government, if they can't afford it on their own, they don't have a job, they don't have an income, the government is no longer supplementing this extra $1,400 a month that they have been paying, these people are going to be in the world of hurt. And so I think something bigger needs to happen, and I believe it will. It just might not happen fast enough. So what you want to do is hold on for as long as you can and help your tenants as long as you can. There's no good data set currently available to estimate how many people may face eviction, but the Eviction Lab has already noticed an increase in eviction filings since some moratoriums have lifted. So you already know that some of the states, some of the counties, some of the cities are lifting it. So of course, they're going to see an uptick. And again, I recommend you work with the folks. At the very least, housing experts and advocates hope the federal government would put in place a uniform nationwide eviction moratorium instead of the ad hoc bans currently has in place. This is one of those things that is very interesting, and I think something has to be done that is more systemic. The problem comes in is that if you only address the rents, but you don't address the mortgage, and you don't address what happens to those banks, there's a trickle up effect. Maybe not trickle down, but trickle up effect. Because if the tenant doesn't pay me, right, then I can't pay my mortgage. If I can't pay my mortgage, then my mortgage company cannot pay the bank or the investors or whatever they got the money to give it to me, right? If they can't do that, then they have to go through their own bankruptcies, and those investors that have put in money, now they're losing. They don't have the income. Now they're actually suffering. They can't pay for their rents and mortgages. So you can see the sort of trickle down, trickle up, however you want to call it. It's a knock-on effect that is affecting everybody. So I don't know what they're going to do, to be honest with you. The only way that I see us getting out of this global debt mess and global fiscal mess is twofold. One is print money like crazy, which is what they're doing. The problem is that printed money is not reaching everybody, and it should. It needs to reach everybody where, all of the debts are being paid off so that we can sort of come to the place where we could reset. The second way that I see that it could be resolved is basically a debt jubilee where they just forgive loans, forgive debt to everybody, come to zero and say, we're going to start from scratch. The governments, the companies, the people, everybody, happy birthday, right? And we're going to start from scratch. And those are the ways that I think long term. Short term, we're going to see some of these things. And, potentially, if it's not bad enough, they might not do any of those things. People are going to get into the world of hurt. We're going to see many people lose their homes, both those that are buying, right, mortgages, as well as those that are renting. That's going to be a very unfortunate piece. Now, if that ends up happening, there's going to be another knock-on effect that we're going to talk about when it comes to housing. So one of those things is going to be affordable housing. So those are going to be things like mobile parks, right? Mobile home parks are probably going to benefit a great deal. Properties that are classified as C and D class properties might perform pretty well because of that stuff. And I do see many more people will need to qualify for Section 8. So as an investor, you might want to consider getting into some Section 8 properties, because that means that the government is actually paying you and you're not relying on just that tenant to be paying stuff and having a job. So just something to think about. And if you have ability to have a portfolio of properties and investments, then when you look at your real estate portfolio, you might want to consider having a difference of things. So you might want to have, for example, a mobile home property, right? Then you might want, and I'm not talking like you getting one mobile home, although that's a solution as well. I'm talking about owning a mobile home park, right? Another piece might be that you're going to have Class A property, which is that high level luxury type of property, and you might have something that is maybe C or B that it offers some Section 8. So that way you kind of spread yourself amongst the different sections. And in a moment, we're actually going to cover some of these things and some of the articles that kind of support my level of thinking. All right, so here we go, another one. Now, what they're saying is, and again, I know that this is March and we're already in June, but, unfortunately, the data often lags, especially in real estate. So real estate is a very slow-moving thing. It's not like stocks or crypto, which are super fast, especially crypto. It's much slower pace, which I personally like, especially when it comes to long-term investing. So they're saying that the delinquency rates remain at record lows despite the coronavirus. Nationwide, 3.6% of mortgages were in some sort of delinquency in March. The number is the same as it was in February, but down from 4% at the same time last year. Now you can take a look right here at sort of what they were able to provide. So you'll see 30 days, 30 to 60, 60 to 90, 90 to 120, more than 90, more than 120, and then of course in foreclosure. The light blue is March 2019. The dark blue is March of 2020. And you'll see something very peculiar. It's actually lower than it was last year, but that's March. That's when things just started, not where we are right now. Okay, so that's something to keep in mind. The latest forecast from CoreLogic Home Price Index shows prices declining in 41 states through April 2021, potentially raising some home equity and increasing foreclosure risk. So you want to take a look at this one right here. And I'm going to have some more water because I'm quite thirsty today. So you'll see that we have some very interesting states that are being listed of what's happening. Now, of course, they're listing the unemployment right here. They're listing the delinquency rate in March and annual change in delinquency over March rate in March 2020. The one piece is that it's March, right? That's the downside of it. But I'm noticing a trend here, which is why I can't highlight this. My apologies. What I'm noticing is that Washington, for example, Hawaii, and New York are highly cyclical, highly expensive states, okay, when it comes to real estate. Not everywhere, of course, because when you break it down, New York City is much more volatile than, I don't know, Schenectady, New York, or Rochester, right? Same thing with Seattle. Seattle and Tacoma are going to be very different. But overall, right, on a bigger picture scale, that's definitely the case. Michigan is interesting because Michigan is obviously, we know that it suffered in 2008 a great deal, but prices have jumped up in downtown Detroit severely. So because we had that high jump, I can understand why it might go down a bit. Nevada, of course, predominantly is going to drive things out of Vegas, and we know Vegas has actually been having a lot of things closed because think about it, who's employed in Vegas? Now, not everybody, but predominantly, it's people that work in hospitality, restaurants, hotels, casinos, right? So entertainment and hospitality industry. And then Florida, very similar thing, although a little bit different. I would put Florida probably same place with like higher retiree. So if they're on a fixed income and we're noticing that the fixed income, the yields are going down, that means they're making less money. That means they can afford less home, whether they're buying or renting, right? So that's kind of one of the things to pay attention to. But we are not done. I got more things for you. Okay, so here we go. This is what everybody wants to know. Housing market is rebounding, which is true. We've noticed some reports of that actually going up. But what happens post-stimulus? So this was a very cool article. My apologies that it's showing up kind of weird on the screen. I tried to zoom in, and when I do that, look what happens. Not much. It actually makes it worse. So I'm going to zoom out, and we're going to stick with it. And I think it has something to do with this video that we're not even interested in. But anyways, so there's an old saying in real estate development business, when a novice makes a mistake, it's because they missed the nuance of the market. When a pro makes a mistake, it's because they missed the obvious. All right? So that's something to keep in mind. Now, all agree that steps were taken very quickly to inject money into the economy and provide relief for people with mortgages. These measures have included direct payments to the general public and aid to small businesses, enhanced unemployment benefits, $600 paycheck for unemployed, right? Mortgage forbearance, rent forbearance, eviction moratorium, limits on foreclosure action, and so on. Massive transfers from federal government have kept the economy from sliding into depression. Many in the housing business are saying there has been a V-shaped recovery in home sales as well as amazing resiliency in the apartment market. But what happens after the music stops? Now, one thing I want to point out about this whole V-shaped recovery, real estate is not the only place where people have been betting on V-shape. Stock market has also been betting on V-shape, as we discussed yesterday, day before yesterday, day before that, and even today. And so, something to pay attention to. Some say that May was their best month yet, and we are hearing the word amazing uttered by executives at these companies. Home builders and developers are feeling more confident, and home builder stock values have doubled since March. Now, part of the reason why some of the home builder stock prices might have doubled is for the same reason why people are buying Hertz, for example, right? It has no value, has no reason other than people are saying, well, it's undervalued, so I'm just going to buy it. They're not buying it with any technical or fundamental analysis or any expectation of the risk of what they might get themselves into. They're just jumping in because Robinhood makes it easy to click a button and buy, okay? So, that's one of the things. The other one is that I agree with this statement right here that people have been saying that May has been amazing. So, homes have been listed, buyers have started to come out, weather was supporting it, people are starting to jump in, and it sounds like the music is back on and things are happening. I actually here in Providence, as I walk around and sometimes do the walk and talk shows as well that I record, I notice many more homes that are being listed for sale, and prices are more or less holding. But what I am seeing also is that these homes are not moving. They have been sitting there. There's a home that I've actually done a video review for my Facebook group back in January, maybe February. That home is still listed for sale. No visits, no prospects, no nothing. And and then we are in June, so we'll see how it works. But again, I'm not seeing much of it happening. Government measures have certainly been supportive of home prices and home sales during the crisis. When forbearance programs and foreclosure moratoria come to an end, we might see a surge of foreclosure activity. More than 8% of mortgage loans are currently in forbearance, according to the Mortgage Bankers Association. Okay, so I'm going to pause over there and say, what is forbearance, right? Like, I hope everybody knows that. That basically means that we put payments on pause, but the interest accrues. And depending on what kind of deal you strike with your mortgage provider, you might be in forbearance for 3 months, 6 months, with the potential to expand another 6 months. Most of these have started in March. If we're talking about 3-month forbearance, we're talking April, May, June. Okay, key month where we are right now. So July is going to be very telling. If you're 6 months, we're talking April, May, June, July, August, September. This is the reason why one of my videos, which you can find actually on YouTube, I talk about September and October being potentially good shopping months if you're looking to get into a property. Okay. Now, of course, then following after that would be 12-month period, which brings us to March or April of 2021. This is the reason why I keep saying that the next 6 to 12 to potentially 18 months are going to be some amazing potential buying opportunities. But of course, real estate is very, very local. And when we do this, I can't cover every corner of the world. We'll be here for like ever. And by the time we're done, it's going to become obsolete. So you got to do your own due diligence by knowing how to evaluate what's happening in your market. Are people buying? Are they selling? Are the jobs happening? Not happening? People moving in? People moving out? What's going on in the market where you want to buy? Okay? You got to know those things. Survey by LendingTree revealed that 70% of people who applied for forbearance actually had the money to pay their mortgage and didn't need it in the strict sense of the word. So what that basically means is that vast majority of people who said, I'm not going to pay it, hey, put me on, basically are having money. They just didn't want to pay it because why pay it if you don't have to? So we'll see, because maybe out of this 8% here, maybe not 8% of all mortgage loans are going to be going through the foreclosure. So that's going to be very interesting and very telling. But it's also possible, the fear that I have is that this 70% right here, sorry, I didn't mean to do that. The 70% of people who applied but didn't need it, my fear is that some of them might have decided to say, I'm not going to pay $1,000 for mortgage, but I'm going to take this $1,000 and I'm going to buy a stock. And then I'm going to ride that puppy up to make money. Now, potentially could be profitable, but potentially could be highly risky. If they don't know what they're doing when it comes to trading and investing in stock market, didn't put in any protective stops or losses or any of that stuff, they could have bought and lost money. Now what? When a forbearance comes in, the bank basically says, all right, you didn't pay for 3 months. Now you owe me $3,000 plus all these different fees, plus all the different occurrence, plus the current month. So we're talking, I don't know, $4,800 to be even or something like that. So if they can't afford it, now we're getting into really, really big deal and big trouble. Okay. People who lose their homes to foreclosure often look for home to rent. This is important to investors. If you're a real estate investor, this is important piece to know. Not only could you potentially buy a distressed property, and you can do that actually even today, you don't even have to wait for that, but you might be able to get a tenant, a very good tenant, who for whatever reason couldn't afford to keep their home. Higher foreclosure rates would add to both supply and demand for single family for rent as well as the apartments, adding more fuel to that already fast growing segment of real estate. The unemployment rate is dropping, which is reducing the number of homeowners who are without income. People think about home as a refuge, and I think that that's true now, especially when we have to work from home, stay at home, can't go outside, right? You have martial law and all of that crazy stuff. And to extend that new home, start to feel enticing, wealthy home features that were not common in pre-COVID homes that could add to demand for those newly built homes. So what some of the sort of top of the marketplaces are doing, they are putting in doors that you don't have to touch, elevators that you don't have to touch, right? Start thinking about it. Extra cautious HVACs and that kind of stuff. So very interesting piece to keep in mind. Going into the crisis, there was an undersupply of housing, and these conditions will continue to support new home sales in years to come because home builders haven't been building it, and we've already done a report about a week ago or so talking about that concept. We're already seeing builder concessions. First-time home buyer market, which was just starting to build a lot of momentum, will probably be set back to some extent. So when they talk about the concessions, they're basically saying, well, we're going to pay your closing costs. We are going to reduce it by X. We're going to upgrade you to stainless steel, that kind of stuff. Those are the concessions that they're talking about. The fundamental drivers of housing demand are still in place. Millennials are continuing to have children that will fuel increased demand in the suburbs and potentially getting bigger homes. We talked about it, from kids to home offices, that kind of stuff. The demand will still generate more home construction, and the outlook for new home sales is promising. I would also say that there's some promise to the current and existing home sales, but that's just me. Now, they're talking about rental housing, so let's talk about it. When rent forbearance measures started to emerge, it was anticipated that landlords would suffer a large number of renters skipping on their rent. April came, collection held solid. May, again, rents were collected and close to normal rates. June, and so far, rents are being collected at high rates. That is very telling and very, very positive. Now, will things go south as soon as the enhanced unemployment benefits drop out? The answer will be different between the types of apartment complexes and properties. The Class A building, this is the part that I was sharing with you, right? That there's a difference between the Class A, Class B, Class C, Class D. And if you don't know what the difference is, we teach it at the Academy. Of course, where else would I teach that stuff than in the Academy? Come on, y'all. So the Class A building have been holding up the best in terms of collections and rents, with some minor reduction in collections in Class B. More significant reductions in Class C, where the tenants have insufficient savings to tide them over. However, there's a bonus with C. Class C apartments are also home to a large number of people who are using some type of supplementary unemployment money to cover their rent. And I also want to add, some people in Class C may also be Section 8, meaning the government paid their rent and the landlord, well, they get paid no matter what actually happens to the tenant's employment or unemployment. So, key thing to remember. The high-end apartments, by contrast, often house people who are renters by choice. The group who could afford to buy a home but prefers the convenience of being a renter. This type of tenant has increased in share in recent years, and with some development renting to people who have income of $75,000 to $100,000, and I would say even above. A building will likely be well supported by demand from this population. There will be some additional downward pressure in rents in the second half of the year, but by next year, rent growth in this type of development is expected to start to reappear despite a fairly full pipeline of projects heading towards delivery. So this is where here talking about the whole concept I was saying. I am expecting the rent prices to drop somewhat. Now, I don't expect the rents to go from like $2,000 a month to like $500 a month, but I do expect it to go from $2,000 to maybe $1,900 or $1,800. I do expect that it might stay at $2,000, but they get 2 months free. That kind of stuff. That's basically what I'm expecting to see, and it sounds like he's basically right there with me. They're also seeing opportunity to set themselves apart by competition by offering healthy home features that are available in older luxury buildings, such as improved HVAC antimicrobial surfaces, some touchless elevator technologies, and so on. So that's kind of the thing that we're going to see in some of these type A, which is that sort of the cream of the crop when it comes to rentals. And so now you understand what property A is. Now, I have sort of mixed feelings about A versus B, and I do teach that in the course. And the biggest reason is that when A loses job, can't afford to pay the premium, guess where they move? They move to B. When the C gets promoted and wants to live in luxurious or more luxurious living environment, well, they move to B. So B wins on the way down and it wins on the way up. That is the reason why I personally believe and prefer B properties, but that's just me. They're likely, now they're talking about the price average and what's going on. So there will likely be some additional concessions at managed rental developments, right? So they're saying 2-3 month worth of rent for free and that kind of stuff. Most accurately in the working class rental buildings. On the sales side, there will probably be an uptick in foreclosures after the moratoria end. The forecast is for flat single-family homes on average for this year, returning slow to rising average home prices starting in 2021. The A project in the A locations will likely remain strong. There will be also different prices among metro areas. The economic and housing effects will be quite different in Las Vegas, Detroit, New York, and Miami. And I do expect all of these to actually go down in prices, but places like Akron, Ohio, Cincinnati, maybe Nashville, potentially Atlanta, Little Rock, Arkansas, that kind of stuff, I do expect that to hold and actually go up in price. The Zillow second quarter home price expectation survey features forecasts from 100 economists, including the author, and those forecasts range from -10 to plus 5.5 for calendar year of 2020. So there you go. They're basically saying that the divergence reinforces the point that in this environment, very little is obvious. And I agree. So that's something that is very, very interesting. And final piece that I want to showcase and talk about, I'm not going to go into the details because we're well into the hour, but there's a change coming to real estate when it comes to technology. And there's also news about blockchain blockchain technology changing real estate. And at some point, I'm probably going to be doing a bit of a webinar and educational session of what that is and how you potentially could participate, because we are actually building that right now within my company. And so I'm really, really excited about that, super bullish on it. And of course, I'll do more about it. But anyways, we are going to stop recording. So YouTube, thank you very much for watching. Have a great day. Until next time, stay forever money blessed. And do remember, you are only one deal away.